Good morning, everyone. Steve's going to be getting on here in just a minute, but I thought this would be a good webinar because I do get a lot of questions about private money or hard money, however you want to kind of call it. It's kind of one and the same. But today, Steve Hayden is going to come on. He's a hard money lender with Paradyme, and they've been around for quite a while. And he's going to be here to answer questions and just kind of give us an overview on hard money, what you can use it for, some of the things that they're funding over there, and answer basically any other questions that you guys have about hard money lending. So as we're going, if you want to throw your questions down in the chat, we can add that in as we move along. So looks like Steve's in. Hey, Steve, how's it going?
Hey, Travis. Good morning, bud.
How's your morning going?
Oh, good. I'm sorry I was late. You know, I one of those things I cannot. When my boss is on the phone, I can't get off the phone with him.
Yeah.
So, no,
I'm sure. Well, you guys have, you have a lot going on over there, so I'm sure he has a lot to talk about.
Yeah, absolutely.
So
well,
I do want to thank you for coming on and giving us an overview of hard money. Like I was just saying, this is a topic that comes up quite a bit, and there's a lot of misconceptions and things like that about hard money out there. So that'd be good to just do an informative kind of Q&A on hard money. I told everybody if they have questions, just throw them in the chat as we go, and we can get those answered for them. So with that said, I guess tell us a little bit about you and Paradyme.
Yeah, sure. Now, first of all, is there video on this, or is it without video?
Should be video. Let me look. I'm going to promote you. You're getting a promotion today.
All right. What do join?
Let's see. I'm going to turn my video on too. Hopefully everybody can still see Steve on the screen. Okay. All right, Steve, be back?
Yep.
Okay, cool. And can you do video maybe now?
Let's see. I might be able to.
Yeah, so there's an update to Zoom, and I don't know. It's
okay.
Controls are a little different today.
No, I'll start either way. So I'm Steve Hayden. I'm with Paradyme Funding. We're a debt and equity firm here in Temecula. We fund anywhere from single-family, multifamily, small deals in Catalina, Georgia, all the way up to $150 million winery projects. For instance, like Europa Village here in Temecula, large-scale townhome projects, storage units across the nation. So both equity and debt. I handle specifically the debt side of things, where I do a lot of bridge loans, fix and flip loans, ground up construction for single family, multifamily homes. So a lot of times, my deals range anywhere from, they're mostly, I would say 95% of my business is fix and flips, where someone comes to me, they get a property under contract, and they're like, Steve, I'm going to buy this house for 200 grand. I'm going to put 50,000 into it and sell it for 350. I arrange the financing on the purchase right there, and sometimes even throw in the rehab for them. That would be the majority of my business. I also do a lot of apartment complexes as well. So that's it in a nutshell. Okay. On what we do.
How long have you guys been around?
Paradyme has been around. I think we've only been around since 2015. I came on 2 years ago. I started with the conventional financing back in 2003,
Okay.
where, yeah, I did a lot of conventional loans up until about 2009. And that's where I kind of veered into the private sector. There's a lot, and the reason I did that is because there's so much paperwork, and there's a lot more paperwork involved now. But I did it because, instead of waiting 30, 45 days or whatever it takes for conventional loans, I went into the private money space, closing deals in 5, 6, 7 days, no paperwork, and it's just, you get paid quicker and it's less stressful, I
Yeah.
feel. Yeah, so I did conventional financing, and then I came here to Paradyme in 2020, exactly 2 years ago. So, and
Nice.
Paradyme's been around since 2015. Yeah, my CEO's been in the business since '03 as well. Has an engineering background. He's flipped over 1,000 homes, done about 1.5 billion in business. So there's a lot of experience here
Yeah.
in our office. Mm-hmm.
Yeah, I know. I've been kind of referring business over to Paradyme for at least 5 years. So I know you guys have been around a while, and I've just been kind of watching you grow, and it's been I don't know, kind of amazing to watch how quickly your CEO has grown that company over there. It's really impressive, actually.
Yeah, and we actually just expanded into the Nashville market. We have an office now. Our headquarters is out in Nashville as of about a month ago, or a month and a
Nice.
half ago. So my CEO goes back and forth from Nashville to Temecula every other week. So
Cool.
he's here this week, and then he'll go there next week and come back, and I'll stay out here, and then we have some of the people out there in Nashville. Yeah, so we're growing big time.
Yeah. Nice. So we do have one question right off the bat. You provide loans in Georgia. They have 164 units that they're looking for a lender on.
In Georgia, absolutely.
Yep. All
Yep.
right. So that
164 units for sure.
cool. And then
Yeah,
Chicago. Someone else is asking about Chicago. I think we could just get it
Chicago,
off the
yes.
plate and say nationwide, right?
Well, so here, you know what? It's pretty much nationwide, with the exception of some of like the brick and mortar states. Nevada is a very tough loan to do. New York is hard for me. New Jersey, Utah. Some of those states are a little bit different. I mean, I can do most of the states.
Okay.
Yeah. So I mean, I can. Yeah. If someone were to just Tulsa, Oklahoma, yeah, I'll do Tulsa.
Okay. Cool.
Absolutely.
So sounds like the bulk of your business is probably fix and flips. Is that safe to say?
Yeah.
Cool. So what I guess how fast typically can you get one of these done? If an investor comes to you, what's the process when someone comes to you and says, "Hey, I found this deal. I think it's a good fix and flip." What are the next steps?
Sure. I think your agents will really like this. So there's two ways that I operate. Now, I operate as, we do have a fund that we set up. It's a secured income fund. It's $100 million for fix and flip ground up construction and bridge loans for the single family multifamily properties. Now, within that fund, I can close deals. It takes roughly, I would say, 7 days to 9 or 10 days, depending on what state you're in, how long it takes to get title work. That's really going to be the only hindrance right there. It requires a little bit more paperwork. I will run credit. I will look at a couple months bank statements. I'll ask you for your ID and your entity docs and maybe a track record for experience. Now, that is one way that I do things, and I can get you really good pricing, in the 7, 8 percentile. Now, that still might sound high if you're not used to private money, but sometimes private money can be 8, 9, 10, 11, 12%. So I can get you in the 7, 8 percentile for a 12-month loan interest only, and probably 1.5% origination. Now, on the flip side, for my California deals, I have a high net worth individual that I partnered with. He has like 50, 60, $70 million. And what he does is he just requires a purchase contract and prelim to draw loan docs. So basically, when someone comes to me, usually a buyer will come to me on a Monday. They'll give me a purchase contract prelim. I run their background, make sure they're not a felon, right? Nothing crazy on their background. Yeah. And I'll draw loan docs on Tuesday. They can sign Wednesday, and as long as we get insurance on the property, we'll fund it that Friday. No appraisal, no application or credit or income docs, nothing. The rate is a little bit higher. You're looking at 8.5% to 9%, and you're going to be charged 2% origination. But for people who really want to get in and have no headache, or provide any documentation, that's a good route to go.
Okay. That's good.
So you're looking anywhere from 5 to 10 days.
5 to 10 days. Okay. Mm-hmm. So what, as far as experience goes, how much does that play a factor into if you're going to provide funding or not for that individual?
So the experience really comes into play when I'm going to add rehab on a loan. So typically now, if you have zero experience and you come to me and you're like, Steve, I want to buy a house for, $200,000 and I do want to put 50,000 into it. I'm going to cap you. I'll need you to put down 20% of the purchase. And I can fund your rehab as long as your total cost is under 80% the loan amount. And you know what? For a lot of people, it's kind of hard to explain on this initial webinar, but you get your total cost. So you got your $200,000 for a purchase price, your $50,000 for for the rehab. So that gives you a total cost of $250,000. For a new person, I would be capping you at lending you 80% of that total. So whatever that amounts to, 250. I don't know. Maybe you have a calculator there. It's probably around
$30,000, right?
What's that?
That we're talking on a 250?
Yeah, 250.
So 20% of the 250 is what they'd be looking at as the down payment.
That's what I'd be able to lend you.
Okay.
Total. So with at least putting 20% down on the purchase. That's why it can be kind of confusing to describe on here and without like a board or something. So I'd be more than happy to, tell people offline on how that exactly works. But here's the thing is, the more experience you have, if you have 1 or 2, 3, 4, 5, plus, you can go higher on that leverage. So, and credit will factor in as well. You have to have at least a 600, but if you have 700, 750 with experience, you're getting max leverage. You can come in with 10% down. I can fund all of your rehab for the most part. So it's credit and experience are the biggest factors right there.
Okay. So the credit's not necessarily going to get you the better rate, but it'll get you more leverage.
Yeah. I mean, if you have better credit, I'm going to still give you, instead of maybe 8%, maybe I can give you 7.5%. It's not going to really make that big of a difference though, because a lot of these people are only taking these loans for like 4 months.
Yeah.
So the difference between 8 and 7.5% on a $250,000 loan amount is probably going to be like a $900 difference. So it's not that huge.
Okay. And so is that what you typically see is about a 4-month loan on this, on the fix and flips? Anyway?
Yeah. If you're doing cosmetic, if you're going to go in there and maybe redo some little kitchen stuff and put some paint and maybe, carpet or something, you're looking at probably 60 days to do that. And then people are going to put it on the market and you have to wait for your end buyer to to finance the loan. So I'd say about 4 months is your average.
Yeah.
4 or 5, maybe.
So do you always make it a 12-month loan in that scenario where it's a fix and flip?
Yeah, I mean, because if they're going to go over now, if you're doing, for instance, on that 164 unit, we'll probably give you more depending on what the renovation is going to look like. I'll go up to 24 months. But
Now,
on a typical fix and flip, you only need 12.
yeah. Let's say someone did do a 12-month loan on a fix and flip, and I don't know, for some reason this runs past 12 months. Maybe it falls out of escrow a couple times, or they have some problems, getting something permitted as they're moving forward on this rehab, and it takes much longer. What would happen if they get past or up to that 12-month mark and they haven't repaid the debt yet?
Well, that has maybe happened once to me ever. You know what? We would probably just extend it for 1% of the loan amount for another 6 months or 3 months. We'll probably give them another 3 months and maybe like charge 1% of the loan, a couple grand.
Maybe a case-by-case basis. You kind of look and maybe see how far along they are, or
Yeah, absolutely. Yeah, because the last thing that we want to do, believe it or not, some lenders may be different. We don't want foreclosures. We're not in the business to foreclose. So we want that product finished. We want you to sell it. We don't want houses that are undone, or because then we have to take on that burden, and plus there's a lot of fees involved, and we would rather come in and make a solution with the borrower.
Yeah. So what would make you, I guess, say no to a property or a deal? Let's say someone came to you and said, I found this, I don't know, this cabin up in Big Bear, and I can get it for 200. And then maybe you look at it, and the after repair value just isn't as high as what they're expecting. How much does that come into play? Would you ask them to put more money down, or if you don't think that spread is high enough?
Yeah, so we will lend again with there's the 3 formulas that you have to hit. You have the loan to value, the loan to cost, and then the loan to after repair value. So as long as your loan that we give you is under 75% of the completed value, then we'll be fine. If that value is coming down low, we'll just fund less or have you come in with more. Mm-hmm. Right. So, and here's another good example of a property that I might say no to. I'm going to do it as a favor. I got my brother. I'm training him, got him into the business. He's got a loan where the borrower has a client or has a property in Indiana. It's in like the middle of nowhere. Population's 2,500 in a county of 45,000. The property is cute and all. However, it's when you get into, sub 5,000 population or even sub 25,000, it could be harder to sell. It could be harder for us to get paid back. It's more risk to the lender. I'm going to do it. I'm going to do it because I'm going to offset it with the fact that the guy has decent credit. He's got experience. So, and it's a small loan amount. It's, $90,000 or $100,000. So I'll take that risk. I think the guy can probably sell it, if not rent it, right? Because he might rent it as well. But location is key in this business. So it's, credit, experience, location. If you go to 29 Palms and you tell me, hey, Steve, I want to put down 15% on a property in 29 Palms, I'm going to tell you to take a hike. So I'm in an area like that, I'm probably going to want 30% down because, when the 2008 market or when it crashed, properties out there in, say, 29 Palms, they decreased by 40% overnight. So, it's not like you're in Newport Beach where the value holds. So the better the location, the higher the leverage. More remote, I either won't do it or make you put a lot down. And here's another thing. So a lot of times people will say, well, what's remote and what's not? There's a good guide. It's huduser.gov, HUDUSER.gov, and you can do a metropolitan lookup, and you can find out if a city is within a county that is metro, and usually we'll like those cities in the metro areas. And if they're not in there, it's going to be a little bit tougher, and you'll know that, right from the get-go.
So you said, now do you do appraisals on any of the properties? How do you calculate for your risk management what you're willing to lend, and how are you estimating the value of the property?
So what we'll do with the California properties, for the most part, 90% of my deals, I'm not doing we'll do an exterior BPO drive-by, and the borrower will never even, see that it happened. If I go nationwide, I'm using my fund. I do interior BPOs ordered by a third party. They'll go out there. It takes 2 business days, so roughly 4 calendar days to get the value. And then I just lend based on that value.
Okay. And that would
I won't really need full appraisals unless the loan amount's over $1 million.
Oh, okay. Now, do you get involved with estimating the after repair value at all, or?
No, what I'll do is I'll just agree or disagree with what value you guys come in at. So luckily for me, I work with my investor. Actually, his son used to work for a big conglomerate, and he would value properties, and that's his sole job. So what I do now is I call him up and say, hey, here's the scenario. Here's the borrower's after repair value. What are your thoughts? And he'll say, well, yeah, that looks good. Or no, Steve, it's a bit tight. So I do that, and they've been in business for 30 years. So I'm very confident in, helping to come out with an ARV, but most likely I'm going to get it from the borrower.
Okay. All right. Now, are you guys providing this money yourselves, or do you have other individuals who you're working with to provide the money, the private investors?
So so as I was saying, we have our fund that we will lend out our money, and that is for all the nationwide products. Sometimes California, I use my investor. Sometimes I use my fund. It just depends on how much documentation the borrower wants to come up with, or how quick they need to get in. If they need to get into a property in 2 days, I'll just use my investor who doesn't require anything, and it's his money, and I can close it, So yeah, I only use that and our fund.
Okay. And would the rate change based on where you're sending it, if you're keeping it if it's your fund or the investor fund?
Yeah, so the investor fund will be about 8.5 to 9%. My fund goes anywhere from 7 to 8.75.
Okay. So if it's your fund, you're probably going to be requiring more documentation and things like that.
Correct.
to get the better rate.
Correct. Yeah, and you know what? I'm going to be pushing more clients to do that anyway, because you can scale with us. I mean, I can take you from a normal flipper to, doing commercial projects we have a lot of capital behind us. And if I were to just use my one investor friend, I'll never be able to scale the client. They'll be stuck to just fix and flips. A lot of these people, they start to realize after a year or two becoming successful at that they want to jump in from single family to multifamily to commercial projects, and upwards. And, we have $750 million under management in our equity side alone, so we can really scale borrowers.
Yeah, that's interesting. geez, I was going to ask a question based off of that. So for a single family home, what would be the largest amount that you would loan? Maybe it's a high-end project.
I'd be looking at about 7 million.
7 million. Okay.
Yeah, I think that's our real, the other day I approved a $6.8 million, hold on a minute. Sorry, got a phone call. Can you hear me?
Yeah, I can hear you.
Okay. Yeah, I approved a $6.8 million property or loan in Bel Air, not a problem. But then I went in for 7.9 or 7.8 in La Jolla, and it's just a little bit too large. So I would say 7 is my cap.
7. Okay. Where would you say most of your clients are finding these properties to flip?
Inland Empire in Los Angeles.
And then how are they finding them usually?
A lot of them work with wholesalers. They'll find wholesalers. They'll go, they'll get the deals from your New Western companies or Net Worth. A lot of them are sending. I know people who spend an insane amount of money on marketing. Sending out mailers. We buy ugly houses. But yeah, I would say Inland Empire is huge. Los Angeles is big. Got a lot of deals in Los Angeles. That's a really good market, and I lend high leverage out there. It's just it always holds value. So
now, do you find it usually like in older neighborhoods? Is that kind of the sweet spot if someone were to look for a fix and flip? Like, what kind of neighborhood should they be looking in?
Yeah, you know what? That's a good question. I do see a lot of properties that are built in the 20s and 30s. Especially in LA. But if you go even to Inland Empire, you can get properties in the 90s and 2000s and still be fine.
Yeah.
Mm-hmm.
Are the older neighborhoods, do you see the biggest spreads on those typically, or?
Ooh. Where do I find the biggest spreads? No, you know what? The biggest spread that you're ever going to get is a major value add. You go to Los Angeles and you pick up a property for, I'm talking high dollar though. They'll pick it up for $1 million, but put in maybe 700 or 800 grand, adding a lot of square feet, and sell it for 3. Those are the biggest spreads you're going to get are value add. A lot of times you're not going to get a big discount on the buy. You have to add the value. That's what I've started to realize.
So maybe someone turning a 2-bedroom, 1 bath into like a 3-2 or 4-2 and a half or something like that.
Yep, exactly.
Yeah.
Adding ADUs are good. I see a lot of people doing that, converting garages to ADUs. That's another good one. Yeah, value add is the way to go for sure.
All right, that's interesting. Now, do you have maybe contractor referrals? Do you help with any, pairing up with contractors or anything like that?
You know what? We do have a few people. I really personally, I can get that within my office, but I personally have referred a few people before, and it comes back to bite me. So
yeah.
Yeah. So I really just want to, it's the same thing with, some people ask me about taxes, and it's like, bro, go to your CPA.
Yeah.
I don't want to get in trouble for anything that I say. So yeah, but there are a few good people out there that I could refer out.
Is that a question you ask at all when a buyer comes, if they have like that plan in place, or?
No, I kind of leave that up to them. And assume that they all have that in place. And that's the biggest thing that you really need. You need your contractors in place. Once you have your finance in place, if they got, with me, I can make it simple. Your finance part is the easiest part. Then you got to work on your GCs and subs and all that fun stuff.
Yeah.
But no, I don't really, I don't really get involved with it
Yeah,
too much. They come to
that's
me with
good.
a plan, with a budget, and
Yeah, I would imagine they should be if they're thinking about doing this. They should have at least some sort of rough plan or something in place. Yeah.
oh yeah, no, absolutely.
So, all right. I think we answered most of the questions in the beginning from everybody. So basically, in a nutshell, if someone comes across the property, they should give you a call, and then you'll make the assessment from there. Maybe they should plan on about 20%. It sounds like.
Yeah, and you know what? To make it simple, this is what I have a lot of my clients do. They text me. I ask them just to text me the address, the purchase price, the rehab amount, and ARV. That is it. And then I'll usually look up the address right away. I'll look at the street view of the neighborhood, and kind of just comp it out right there. And then I'll
Mhm.
give them a call and say, hey, what are we looking to do? You look at 15, 20% down. Do you need me to finance rehab? I will tell you it's more beneficial when the client actually finances the rehab. You're going to get better pricing. You're not going to have to pay interest on it. You're going to close the loan quicker. It just becomes. I do want to clarify one thing here. On when you do rehab loans, and we fund it for you, um, it is a reimbursement schedule. So let's say I gave you, your full loan amount, but held $50,000 in a fund control. You're going to start the work first, and then we're going to reimburse you.
Mhm.
So you're gonna come out with a predetermined schedule, like 5 draws of that 50,000 for 10,000 each. You're gonna do $10,000 worth of work. You're gonna submit a request to me saying, "Hey, Steve, I want my $10,000 back." I'm gonna send an inspector out, make sure that work is 100% complete. The inspector is going to give me back the report, and then I'm going to ACH you the funds. Process takes about 5 to 7 days for you to get your money. But just keep in mind, so you'll have fund control inspectors involved if you're doing fund control. And
Okay.
make sure also another key thing is with those budgets, try to keep what you're doing originally when we fund the loan, try and keep on track with that during the process of the rehab. A lot of people come to me and they wanted to install an AC, and then when it comes to it, they are installing heaters or something, or something, or a pool or something that's completely different. I can't give you credit for that, and it's going to mess with, the budget and how we reimburse you. So that's a big thing that I'm now starting to educate people on. So I'll educate when the deal comes. I just wanted to throw it out there, kind of make sure to bring it up to me if you chat with me.
Yeah. So definitely they should have that in place before moving forward. Like, these are the scheduled repairs or upgrades or improvements that we're going to be making, and don't add in as you're going, hey, this would be even better if we tore down that fence and put up a new block wall.
Right. And I know that there's going to be changes, but that's why you always put in a contingency, put in 10, 15% at the beginning. Always expect that there's going to be some kind of problem or
Yeah.
something. And we can make line item adjustments. We can do that. I'm just letting you know it's going to slow down things.
Yeah.
And and sometimes you might have to pay for things out of pocket. So always have some reserves with you.
Okay. Let's see. I think we've answered all the other questions. Cool. Well, that was really informative. Guys, if you have any potential projects, fix and flips, or anything like that, give Steve a call. I'll send out his contact information in the replay. But I know you're funding a lot. I follow you on Facebook, and I see a lot of your fix and flips that are getting funded. So it's nice to work with someone who knows what they're doing and has been doing this for a number of years, to just make this an easier process, especially if you're kind of getting started with this, you know, or thinking about it.
I appreciate it, bud.
Yeah. Well, thanks for coming on. I know we'll be in touch. I know I have at least a couple calling you today, so about some potential projects. So
Great. Yeah.
Other than that, thanks for coming on, and I'll be in touch, you know, as usual.
Yeah, let's chat.
So,
all right,
yeah.
let's chat. I hope you have a great rest of your week.
Right on. Okay, we'll see
All right,
you.
I'll talk to you in a little bit.
Talk to you later. Bye bye.